You're listening to Uranium Spotlight Podcast, sponsored by Purepoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, understanding when and how the uranium market turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's January 27th, 2026, and this week on Uranium Spotlight, prices step higher as availability tightens. Geopolitical disruptions further restrict supply. Africa's uranium map quietly shifts. Canada looks to India, and Laramide makes a decisive strategic pivot. The uranium spot price closed last week at $87.15 a pound U3O8, up from $85.40 the week before. Activity remains steady, with buyers focused on securing material rather than testing price levels. Offers continued to thin, and sellers showed little urgency to part with pounds. The long-term price also moved higher, closing out January at $86 a pound, up $2 from the prior month. That continued rise in long-term pricing reinforces what utilities are signaling through their behavior. Coverage matters more than timing the market, and replacement supply is not arriving quickly enough to justify waiting. What stands out is the absence of a single catalyst. This is not a headline-driven move. Prices advanced because the underlying balance continues to tighten. Spot availability remains constrained, while long-term contracting steadily absorbs future production. For investors, the key takeaway is that when both spot and term prices move together, it reflects structural conditions, not sentiment. The tightening conditions we're seeing now are one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when uranium's real move is about to start. Get it now at uraniumspotlight.com. A large shipment of uranium concentrate originating from Niger remains effectively stranded, now being held at the airport outside of Niamey. What would normally be a routine export has turned into a geopolitical stalemate. Overland routes through western Niger and Burkina Faso have become untenable due to security concerns, while coastal exit options are blocked. Togo has stated that it would seize the shipment if it entered its territory. With land routes closed, attention is turned to air transport. Satellite imagery last week revealed Russian-built cargo aircraft at Niamey's airport, though the planes do not appear on standard flight tracking systems and their purpose has not been confirmed. At the same time, the uranium cannot legally be sold. International arbitration rulings prevent Niger from monetizing the material, with penalties enforceable through frozen aid and financial accounts. Russia's state nuclear entities have been deepening ties with Niger, openly stating that uranium mining is a strategic objective. Whether or not this specific shipment moves soon, the damage is already done. For investors, this matters because material caught in geopolitical limbo is effectively removed from the market. Each disrupted shipment tightens availability elsewhere and increases the premium placed on politically reliable supply. In southern Africa, a subtle but important shift is underway. The Industrial Development Corporation of South Africa has announced plans to divest its remaining 10.2% stake in the Rossing uranium mine in Namibia, ending an investment that dates back to the 1970s. Rossing's ownership structure is complex. Namibia holds a small equity interest but retains majority voting control. Rio Tinto exited years ago, Iran remains a long-standing minority holder, and now South Africa is stepping away without disclosing valuation or timing. This comes as Namibia signals a growing interest in developing nuclear power and deepening cooperation with neighboring countries. South Africa already operates nuclear reactors and has decades of operational expertise. Namibia brings uranium resources. Together, they represent a potential regional alignment that did not exist in prior cycles. The key point is not the transaction itself, but what it represents. Long-held strategic uranium positions are being reassessed as the market transitions from surplus assumptions to scarcity realities. For investors, the message is that ownership of uranium assets is becoming more strategic, more political, and more valuable as future supply paths narrow. Last week, Canadian Prime Minister Mark Carney announced plans to travel to India in early March to pursue a trade agreement, specifically referencing uranium and nuclear cooperation alongside energy, mining, technology, and AI. This is more than routine trade diplomacy. It reflects a changing uranium trade map. Canada has historically relied on the United States as its dominant export destination. With trade friction and tariffs now disrupting that relationship, Ottawa is clearly prioritizing diversification. India matters for two reasons. First, it is one of the few countries with the scale and population growth to support sustained nuclear expansion over decades. Second, it's increasingly positioned to sign long-duration agreements that secure fuel supply well in advance of reactor builds. At the same time, several traditional uranium-producing regions, including Kazakhstan, Niger, and parts of Africa, are moving closer to Russian influence. That raises an uncomfortable question for Western utilities, particularly in the United States, which operates nearly 100 reactors and produces only a fraction of the uranium it consumes. For investors, this matters because uranium trade is no longer just about price. It's about alignment, security of supply, and who trades with whom. As these lines harden, reliable exporters like Canada take on greater strategic importance. Laramide Resources made a decisive move last week, exiting its greenfield exploration program in Kazakhstan following sweeping changes to the country's subsoil legislation. The new framework requires foreign companies to accept 75 to 90% state ownership of any future uranium discovery, effectively eliminating commercial viability. This shift came just as Laramide was preparing to begin a large multi-rig drill program after completing targeting and permitting work. Rather than remain exposed to escalating political risk, the company terminated its option agreement and redirected its focus to its core assets in the United States and Australia. In New Mexico, Laramide continues to advance its Church Rock in situ recovery project through the federal Fast 41 permitting process, targeting a potential production start later this decade with operating costs near the low end of the global curve. In Australia, the large Westmoreland project remains politically constrained but retains significant long-term optionality. For investors, the key takeaway is that Kazakhstan has effectively reduced the industry's ability to replace reserves. That makes existing assets in stable jurisdictions more valuable and reinforces the reality that future uranium supply will be harder to secure than the market once assumed.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by Purepoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.